Forrest. Thanks, Dana. So now that we've used some crude math to determine your living expenses, we can apply the 20 times rule. We're just going to take your living expenses, multiply that by 20, and the product of that formula gives us a reasonably good portfolio at retirement. If you haven't already done so, please take a moment just to make that computation for yourself. Take your living expenses and multiply that number by 20. The reason we say that a 20 times portfolio is a reasonably good one is because of what it produces in retirement. Here, unlike the first scenario, this portfolio holds up well over time. Living expenses are $100,000, and fortunately, this couple retires with a 20 times portfolio. 20 times 100,000 is $2 million, which is what they've amassed when they retire at age 65. We held the inflation rate constant at 3% and the return rate constant at 8%. Now, while we like the 20 times rule for its convenience and as a general gauge of a retirement portfolio, we also accept its limitations. This graph is supported by the idea that inflation does remain constant at 3% and that investment returns remain constant at 8%. We all know the market doesn't work that way. Returns vary year to year quite a bit. And particularly when you move into the withdrawal phase of your life, this variance is all the more significant because your portfolio becomes more sensitive to it. To illustrate this point, we designed a 31-year study. We looked at a $1 million portfolio with a constant withdrawal rate to see how it would hold up over 31 years when we actually varied the inflation rates and the investment returns. What you see here are two equal but opposite scenarios. In the first scenario, we run the sequence of market returns forward, starting in 1973 and ending in 2003. Then we do the opposite. We run the sequence of market returns backwards, starting in 2003 and ending in 1973. As you can see by the statistics below, the return characteristics are identical and the risk characteristics are identical. And if you were looking at these two scenarios in your accumulation phase before you start withdrawing money from your portfolio, then the results are intuitive. Those identical return characteristics and risk characteristics give you the same result. The form of the lines is different because the sequence is different, but the end result is intuitive and the same. But the math changes once you move into your withdrawal phase. Once you start taking distributions from your portfolio, things change. As I mentioned, portfolios in the distribution phase are much more sensitive to market variance. And as we see here, when we ran the sequence of market returns forward from 1973 to 2003, the scenario ended badly. That's because in this particular case, this portfolio suffered from the bad years of the bear market of 1973 and 74 and didn't get much help until the bull market of 1982. By that time, this portfolio had lost the critical mass it needed to slough off the burden of withdrawals, and it expires early, 17 years into retirement. Alternatively, the second scenario, where the sequence of market returns was run forward from backwards from 2003 to 1973, this scenario ends with a positive result, with $8 million in the bank and some very happy heirs. For this reason, because portfolios are so sensitive to market variance in retirement, we see it necessary to administer three kinds of tests to the retirement planning that we do. Dana, could you tell us a little bit more about that?
Great, thanks, Forrest. So oftentimes planning starts with a test known as straight line planning or the straight line test. And for many planners, this may be the only test that they run your specific plan through and your variables through. What we've seen is through technological advances, we're now able to run some of the various tests that we'll get into in just a moment. Planning alone is valuable, and if you do nothing but straight line planning, it does provide value. It does provide you with a context of Do you have enough? Using these variables. That said, the weakness here is it's assuming that the annual rate of return, for example, is constant each year. And so with that, the weakness that we see in the straight line planning technique is that, in essence, it's operating in a vacuum where everything is occurring systematically the same year in and out. And you don't and are not subject to volatility, market fluctuations, and how those impact your longer term goals, specifically in the distribution phase of your life, as Forrest was illustrating a moment ago. So what we do now is we really run all of our clients who are going through the planning process through a variety of different advanced techniques. And the first one and the next one would be to stress test using a bad timing indicator. Now, what this says, or what you're looking at here is, I guess, first and foremost, you see the green line, which looks quite nice. That's the straight line plan. Now, the red line, you can see, runs out of money fairly quick, and that's known as the bad timing test. What that says is, in the distribution phase of your life, what if that first year or in those first few years, the returns within your investment portfolio were quite weak, were quite negative? Perhaps people who retired in 2007 or 2008, they may have realized something like this, and that can be unfortunate. But what makes the situation more manageable is if you've run your numbers through a test like this, so you know the possibility exists. And what Forrest is going to talk about in a moment is really taking all of this to the next level and the most advanced level using a technique referred to in the industry as Monte Carlo analysis.
Thanks, Dana. Monte Carlo analysis is perhaps the best way to test for market variance. And as we've indicated, when you reach the withdrawal phase of your retirement, your portfolio becomes particularly sensitive to market variance. And that is where Monte Carlo analysis comes in. Monte Carlo analysis crawls back through 40 years of history and randomly recombines returns over that period to imagined scenarios. What you're looking at here is a spaghetti graph and a sample of 100 trials imagined by Monte Carlo analysis, randomly combining different returns over the last 40 years. As you can see, some of these scenarios succeed and others do not. The beauty of Monte Carlo, though, is it does not ignore the possibility of bad luck, and it does not ignore the role of variance in success for retirement planning. It runs the statistical equivalent of 10,000 of these trials to generate a probability of success. At Bell Investment Advisors, we do not endorse any plan that falls below a 70% probability of success, but after that, planning becomes philosophical. For some clients, they are really looking forward to moving ahead and into their retirement years to enjoy their lives, and 70% probability of success it suffices. Other clients really prefer to continue making the sacrifices and changes they need to have a probability of success that reaches the high 80s or 90s. The final use of Monte Carlo analysis is that you can use it as a guide to your asset allocation. As I mentioned earlier, sometimes when we run Monte Carlo analysis, we find that clients are allocated too aggressively, and that being aggressive actually diminishes their probability of success. Alternatively, it's possible to be too conservative. Remember, we're seeing retirements of 2 and 3 decades now, and over that span, it's really important to make sure that your return is high enough to support a long retirement. We are very proud of the technology and strategies that we use here at Bell to decide on how we allocate our clients' asset allocation. This is just a chart that shows our average account returns from January 1999 through March of 2010. We are proud of the technology and strategies that we use to find these asset allocations because they really help support the retirement plans that we put in place. Certainly much better than other well-known indices like the S&P 500 or the MSCI EAFE, which is sort of like the S&P 500 for Europe, Asia, and the Far East. With that, we want to conclude with a list of questions that will help you assess where you are with your retirement planning and the services we use to help our clients answer those questions.